Today, we're really dissecting the core of recent market events. Think economic shifts, central bank talk, key market moves.
Everything that's shaping finance right now.
Because the US dollar weakness, well, it's pretty significant, isn't it?
Oh, absolutely. It's dominating the chart.
We've seen USDCHF, it's been sliding sharply, hitting lows not seen since, 2011?
That's right, 2011. It's now trading around 0.7904. Came down hard from 0.8170 in like 6 trading days.
Wow. And it's not just CHF, right?
Yeah.
USDJPY also took a hit.
Yep, over 500 pips down there too. It's broad dollar weakness.
So what's really behind this? What's driving this pretty aggressive dollar retreat?
Well, what's fascinating, I think, is how it connects beyond just the currency chart. It ties directly into the U.S. debt market.
Lower yields.
Exactly. Lower yields are supporting the dollar's decline. Seems like a big unwind of positions. And for USDCHF, it's not just the level itself, 0.7904, but the fact that it's challenging that really long-term support near 0.7709.
That September 2011 low, right?
That's the one. Now, keep an eye on resistance, too. That 100-hour moving average around 0.7986, if it breaks above that, maybe we see a shift in momentum.
Okay, so dollar weakening, lower yield expectations.
Yeah.
What about gold? You'd expect that to react, wouldn't you?
You would, and it has, though maybe not explosively at first. It was kind of range-bound after the Israel-Iran tensions eased off.
But recently,
Yeah.
we've seen a bit of surge, dip buyers coming in.
Absolutely. That recent uptrend, it makes perfect sense. It aligns with the market really expecting real yields, inflation-adjusted returns to keep falling.
Because the Fed might cut sooner.
That seems to be the bet. If inflation stays soft or if the job market starts looking weaker, the feeling is the Fed might get more aggressive with cuts. Gold's kind of front-running that potential dovish pivot.
Right, pricing it in. And this brings us neatly to central banks, because their commentary is really adding fuel here, isn't it?
It really is. We've had a whole wave of comments, especially out of the Eurozone.
Yeah, the June inflation numbers.
Yeah.
Headline steady at 2.0% year over year, core at 2.4%. What's the main takeaway from the ECB's stance right now?
Well, connecting the dots, the big signal isn't just that they're in pause mode for the summer, which, yes, several officials confirmed.
Okay, pause mode confirmed.
But it was ECB's de Guindos being unusually open about specific exchange rate levels that was striking.
What did he say?
He basically said USD at 1.7C is okay, maybe even 1.20 could be tolerated, but higher than that would be challenging.
Wow, that sounds like a soft cap.
Exactly. It suggests they might be willing to use the currency level subtly as a policy consideration. That's quite a shift from how central banks usually talk. Mueller and Nagel chimed in too, saying rates should stay on hold, policy is neutral.
That's a really crucial insight. A new dimension to policy signaling, perhaps. And speaking of signals, that big central bank panel today at the ECB's Sintra Forum, Powell, Lagarde, Bailey, Ueda, Rhee.
Yeah, definitely one to watch for more clues on the global policy direction.
Okay, let's shift gears slightly. Broader catalysts, innovation. That B2M8 event had some interesting points. Economist Azad Zangana talking about gold.
Right, he highlighted gold's surprising underperformance back in November, even when fundamentals seem supportive.
Which tells us what? About the gap between fundamentals and maybe investor sentiment or positioning.
It really raises questions about, market conviction. Even with clear tailwinds, investor behavior can diverge. And he also touched on those recurring questions about the dollar's reserve status.
Ah, yes, the perennial debate.
But the key point wasn't just raising the question again. It was highlighting the practical issues with alternatives. The euro's liquidity challenges, the yuan's capital controls.
So the alternatives aren't quite ready to step up.
Not really. They face significant hurdles. So while the dollar's dominance is being questioned, it's still kind of the default, even if challenged.
Got it. And sticking with B2Me, there was another really key takeaway about trading. The competitive edge isn't just about price anymore.
Not at all. That was a major theme. The edge has fundamentally shifted. It's all about execution speed and infrastructure now.
Ultra low latency
is now just the baseline. It's not a differentiator, it's table stakes. If your infrastructure isn't lightning fast, you're basically not even competing.
That's a huge operational shift for market participants. Okay, and just quickly wrapping up on the policy side, U.S. trade.
Yeah, White House CEA Moran sounded optimistic about a deal with the EU. Meanwhile, reports suggest the Trump administration is aiming for narrower, sort of issue-specific deals for quick wins.
Before those reciprocal tariffs potentially snap back on July 9th.
Exactly. And Treasury Secretary Bessent mentioned moving towards a vote today on big, beautiful bills, so domestic legislative action potentially in play too.
Okay, so pulling all this together, what does it all mean for you listening in? We've unpacked these key market moves, the central bank signals, the shifts in trading, giving you, hopefully, a clear picture.
Yeah, and it leaves us with a pretty important question for you to think about, doesn't it? You've got this ongoing currency volatility, you've got central banks sending these cautious, nuanced signals, and this relentless demand for speed in trading. How might all these forces tangled together actually redefine what risk and opportunity look like in the global markets for the rest of this year?